What's going on, my fellow wealth creators? Matty Ice here. Welcome to another training. Today, we're going to talk about the difference between 529 plans and whole life insurance contracts when it comes to saving for college. Now, when you hear that, you might immediately ask yourself, like, what the heck does whole life insurance have to do with saving for college? It actually has a lot to do with it, guys. And in fact, it can be just a phenomenal alternative to these 529 plans. Now, I'm not saying don't explore and do your research on 529 plans. Speak to your advisor. It's not specific financial advice or anything. But here's why I do these videos and these comparisons between whole life insurance and these other traditional tax advantage or tax qualified plans, when it comes to same college, retirement, whatever, is how do we know we're making the best decisions for ourselves and our families if we don't know what all of our options are? At the end of the day, that's the biggest thing for me. Know what your options are and how those options work so that you can make the best decision to reach your goals. Is it a 529 plan? Maybe, but maybe it's a whole life insurance contract. And I'm telling you guys, when I started going down the rabbit hole of infinite banking, using cash value, dividend paying whole life insurance, it just blew me away at how many benefits and how many different use cases we get from one whole life insurance contract. They are so powerful when they are structured and set up correctly. Man, I just don't know of a more powerful financial asset that I've come across anyway. So might be a little bit of a longer video, but that's just because I want to go into as much detail about these things as possible, so that just to help you guys along your journey, specifically when it comes to saving for college for your kids. Obviously it's a pretty big expense, so we want to make sure we're using the best assets available to us to reach that goal, right? All right, so I want to start with 529 plans. So let's break these down, and I want to go through the three main pitfalls, the three main issues that I have with 529 plans that I think are the most important for people to know when considering a 529 plan and weighing their options, right? So number one, it's invested in the stock market. The money you put in, it gets invested in the market. And I'm just not a big fan of relying on the volatility of the stock market to reach my goals. Especially when we're talking about a very limited time frame, guys. A lot of these plans get set up, when we only have 10, maybe 15, maybe 20 years long. If we're thinking like a little bit longer term, but 15 years to save up for college, for when our kids are going to go to college, right? So we don't have a long enough time frame to take advantage of the typical average rate of return that the market might get. Say if you are planning for retirement, right? If you invest in the market, dollar cost average, whatever, over 30 years, that rate of return that you get over that period of time is going to look a lot different than if you only do it for 10 or 15 years. So do we have enough time for the stock market to do what we need it to do in order to reach our goals? I mean, I suppose if you invest at like just the right time, you're like at the beginning of a bull market, right? Maybe it could work out, but what if you don't? What if there is a lot of volatility? What if, we hit, heck, they call 2000 to 2010 the lost decade because we had the dot-com crash. We had the 2008 financial crisis as well. So it's things to think about. Do we really want to rely on the stock market to reach our short-term goals? For me personally, no, definitely not. So here's the other question to ask yourself, guys. When we're talking about financial products that are invested in the market, is what happens when we start to make withdrawals? Like our kid starts going to college, we're going to start taking money out of this 529 plan to pay for the tuition, the rooms, etc. What happens if the stock market goes down while we're doing that? That can have a massive impact on the amount of money you were planning on having for your child's college education. If the market goes down 10, 15, 20% in the year that you start making withdrawals, your kid starts going to college, how long is that money going to last? How many years of tuition will it actually cover? So will that happen? I don't know. That's the thing, though, is we don't know what's going to happen with the stock market. That's why I'm not a big fan of utilizing it as a way of accomplishing, financial goals. Now, again, pros and cons to everything, guys, could you potentially get a higher rate of return than, say, for example, something like a whole life insurance contract? Maybe. If that's the only benefit you're looking for, then that's something to consider is, can I get a higher rate of return? Maybe. Maybe not, right? And do you really want to gamble your child's education on the gamble of the stock market? I don't know. For me, it's just I'm not a big fan of it, right? Pitfall number two is the limitation and restriction that it has to be used for college. Okay, there's no flexibility for. There's really no contingency plan here. If you ask yourself, I mean, like, what would you do? What do you do with this? Since it can only be for college. What if your kid doesn't go to college? A lot of people don't. What if they decide to start a business, become a real estate investor, real estate agent, life insurance agent, whatever. If they choose a career path that doesn't require a traditional college education, what do we do with it? Well, unfortunately, you have to pay a penalty to get that money out. And you might be able to roll it over into like an IRA or something like that. Talk to your advisor. Again, it's not specific financial advice or anything, but speak to your advisor on what your options would be. I imagine it would be different from state to state, but these are things to think about, guys. Is what happens if your child decides not to go to college and they want to start a business? Would you be able to use the money in the 529 plan to help them start their business? No. The money in the 529 plan can only be used for qualified educational expenses as defined by the IRS, at least in order to get the tax advantages of these plans. It has to be for very specific expenses related to college. So having that limitation on what I'm able to do with my money, I'm just not a big fan of, right? Pitfall number three. This can be really frustrating, is it impacts your child's ability to get financial aid and scholarships. I've heard, when I was doing my research on 529 plans, I listened to a story of a gentleman who had a friend, their daughter got, I can't remember the exact amount, maybe a 75% scholarship or whatnot, that they actually took away. And then they also lowered the financial aid she was able to get. When you're filling out that FAFSA, they're you got to put your income and, what do you have in these 529 plans? If you have too much money in the 529 plan, meaning you did the right thing and the plan worked out for you, the market performed, whatever, you were the responsible person doing the right thing, planning for college, that can actually penalize you or your child in the sense that it's going to impact their ability to get financial aid and scholarships, right? I can't imagine how frustrating that would be if, if your child gets a scholarship because they did really, really good in school, and then they're penalized for how much money you were able to save and prepared for their college, their college education. Like that to me would just be really, really frustrating. So, again, there's pros and cons to everything, guys. I'm just, I'm sharing my journey. And, as I learn these different things, I just want people to know how these things work, what the pitfalls are, what are the things to look for, questions to ask, to make sure that you are doing the best thing to reach your goals. Are we putting our money into the best things to reach our goals later on, right? So let's move on to whole life insurance. My favorite. I absolutely love whole life insurance. I think it's by far one of the most powerful financial assets I've ever discovered. But let's talk about it specifically for college planning. Because again, it's not really something that we hear in traditional media or from your average financial advisor as a potential alternative to the traditional ways of planning for college, right? So it doesn't have any of the limitations that I've already mentioned about 529 plans. So it doesn't have to be used for college because it's a whole life insurance contract. So in the event that your child does not want to go to college and they want to start a business or get started with real estate, maybe they want to become a realtor, life insurance agent, different trade school, whatever, you can still use the cash value inside of the whole life insurance policy. That's where our ability to plan for college comes from, is the growth of our cash value inside of a whole life insurance contract. All right. You can use that for whatever you want, whatever your child decides to do, whatever career path they decide to take, you can utilize the cash value for whatever they want to do. Okay. So there's a lot of flexibility, and you don't have to worry about whether or not your child's going to go to college as from a financial standpoint, if we're planning for these things, because it can be used for anything. All right. Also, it does not impact financial aid or scholarship. So if they do go to college, and you're filling out that FAFSA form, or let's say they got a 75% scholarship, the cash value in your whole life insurance contract has nothing to do with FAFSA or any scholarships, anything. It does not impact any of that. So a lot of flexibility. So they can get their scholarship. Let's say it's a 75% scholarship, or they get XYZ amount of financial aid. Plus, you have access to all the cash value that's built up over however many years that you can now use to assist with whatever's not covered when they go to college, right? So really, really powerful, a lot of flexibility. Safety, guys. Like I was mentioned earlier, I'm not a huge fan of using the volatility of the market, potential for returns. Like, we just don't know what the market's going to do. And again, do we have enough time for the market to do what we need it to do to reach our goals? I don't know, maybe. But I like the safety of whole life insurance contracts as well. I mean, it's about the safest asset that we can have. I argue that it's actually safer than having it in a bank as well. I've done a video on this. You can check it out in the description. But we don't have to worry about the volatility of the markets and market crashes and things like that. Our cash value is actually guaranteed to grow every single year. That's how these whole life insurance contracts work. Plus, we get dividends. So you have the growth guaranteed growth rate plus any dividends they get paid. And most of these companies, these life insurance companies, they paid a dividend every single year since inception, right? So there's a lot of safety there. As far as how these contracts go, it's also tax advantage. You get your cash value grows, tax deferred. It's technically tax free as long as it's set up, designed, and utilized properly. But you can access the cash value tax free to help pay for your child's college education. And there's a couple of different ways to do that. And I'm going to show you that we're going to go through a couple of different scenarios in a minute when I take you to like a real life whole life insurance illustration. We'll look at some numbers and we'll walk through a couple different scenarios, but you get really, really good tax advantages with these whole life insurance policies. I'm just going down my bullet points here in my notes. So you get the guaranteed growth. Here's the other thing, guys. This is really interesting. Did you know that you could actually get market participation in a whole life policy? Now, it's not really well known because it's not very common. Most of the time, the whole life insurance policies have nothing to do with the market. However, there is a specific company with a specific type of product, and you can use it, you could not use it, all right? And you're not technically invested in the market. I'm not going to go into a ton of detail about how the product works in this video. If you want to learn more about it, I'll have training on it in the description that explains how this works. But basically, you could get the guaranteed growth rate of the life insurance contract. And then also, if the market goes up, you could participate in some of the market upside potential, but you have downside protection. Now, I want to specify clarify, this is not an IUL or Index Universal Life. All right. If you have no idea what I'm talking about, that's a good thing because not a fan of those. This is whole life insurance. Okay. But you can get extra growth, cash value growth in your policy by having some market participation. So if you're comparing a 529 plan and a whole life product, and like usually, it comes down to rate of return. I can earn more in the stock market. And that's why, some people will take the 529 plan over a whole life insurance policy. But what if you could get some of that market upside potential without the downside risk? You can do that with a whole life insurance policy, guys. That exists. It's called indexing. And yeah, like I said, I go into more detail on how that works in the description, but just keep that in mind. If you're on the fence, and the only reason is because you can maybe get a higher potential rate of return, you can get upside potential in the market in a whole life insurance policy. So keep that in mind. All right. Withdrawals and policy loans, we're going to go through that when I pull up the illustration. That's how you access, it's different ways to access the cash value for your kids' college education when they actually get to college. Here's another major benefit of whole life insurance and why I think it's far superior to a 529 plan is it provides the death benefit. Okay. Let me ask you this, guys. If you're putting money into a 529 plan, okay, let's say you're 5 years into it. Okay. What happens if something happens to you? Now, maybe you have term life insurance, and that's great. And that's absolutely better than not having life insurance at all. But what if you get all the benefits I've talked about so far, plus the death benefit, in case something happens to you. That way you don't have to worry about the limitations of 529 plans and then term life insurance, which is going to expire. You lose all the money that you put into the term life policy. That's a whole other conversation. But this is massive, guys, because look, the chances of something happening pretty slim to none, but what if? There's always that possibility. There's always, things happen in life, guys. So what would happen if you passed away tomorrow or you became disabled, like, and you can't work anymore? How are you going to continue to contribute to your 529 plan? How would you continue to provide for your child's college education? Be very, very tough if all you have is a 529 plan. With whole life insurance, you have that death benefit protection in case you pass away prematurely. You can pass that death benefit on tax-free to your kids for their college education. Or again, there's no restrictions on what they can use it for. But if you wanted to specifically use it for college education, they could do that. It also, these policies come with living benefits, meaning if you become disabled, you get a chronic illness, you can't perform 2 of the 6 daily activities of living. I think I said that right. Or maybe you get diagnosed with a terminal illness and you can't work anymore. You can access a large portion of that death benefit to cover those expenses. Again, potentially, help pay for college. There's no restrictions on how to use that money. But to me, that is a huge benefit over 529 plan. Like, if you passed away tomorrow, would the money in your 529 plan, would that blossom into a massive death benefit, tax-free, that would immediately go to your beneficiary, your loved ones? What would happen to that 529 plan if something happened to you? Right? Something to think about, guys. And that's just another major, major benefit that we get with these policies. Here's the other thing too, guys. This policy, these life insurance policies, they can be also used for your retirement later on down the road. If you want, if you set these up correctly and you take depends on how you take the money out for your kid's college. It impacts the growth of the policy long term, but you can actually use this for your retirement. Can you do that with a 529 plan? Can you use the money in a 529 plan for college, for your kid's college education, and then use it later on for retirement? No, you can't do that. You can absolutely do that with a whole life insurance policy when it's set up correctly. So with that said, I want to pull up an illustration. Let's go through a couple of different scenarios here. All right. And we'll look at some numbers. Let me go ahead and share this. All right, guys. So let's go through this illustration. Now, here's the thing. This is a very basic illustration. There's a lot of different ways you can structure these policies, guys. It just depends on your situation, what your goals are, how much you're able to save each year. That's a really cool thing about these whole life insurance policies is we can get very creative on how we design them. So keep that in mind. Now, there's a couple of basic things that I want to point out. First is the death benefit. All right. I alluded to this earlier. This is a major benefit that we get. Like, again, what were to happen if you were to pass away tomorrow? How would you provide for your kids' college education? This is a great way to do it, to have that death benefit. Maybe you have term insurance, maybe you don't. But here's the thing is if we get all of these other benefits in addition to the death benefit, why not just have the whole life insurance policy instead of term insurance and then the 529 plan or whatnot? Why don't we get all of these amazing benefits in one asset, right? And, this is, we're saving $10,000 per year here. You don't have to do 10,000 per year. You could do 5,000 per year. You could do 100,000 per year. Like, there's no limitation on what you can put into these policies. But this death benefit is it's really, really powerful for protecting our loved ones. But in this particular case too, making sure that no matter what happens, our kids will have the money they need for the college education that they're looking for, right? Pretty sizable death benefit here. Okay, so the other thing I want to point out is you'll see here we're paying premiums right here for only 20 years. You don't have to pay into a whole life insurance policy for your whole life, guys. I don't know if you're aware of that. I wasn't aware of that, not that long ago, before I started going down this rabbit hole. But you could pay into it for 20 years. We could cut this off in year 10 if we wanted to. We have that flexibility, so keep that in mind. You can contribute to these policies for a specific amount of time if you want. All right. And that's where, working with an agent that knows how these policies work is so important so that you can design it around your goals and your situation. All right. But let's get into the actual numbers here. All right. And we're going to keep this pretty straightforward. Let's say 15 years goes by. All right. At this point, we put in, what is that? $150,000. All right. In year 15, if we scroll over here, our net cash value, this is the number that we're looking at to determine how much money we have available for our kids' college fund here. All right. So we have $173,602. Wow. I really butchered that, didn't I? $173,602. I was going to stop at 173. All right. So we put in 150. We have access to roughly like 94, 95% of this number. I'm just going to say 170,000 to keep it simple. All right. So we put in 150. We have access to an extra $20,000, 170. So our policy was growing the entire time that we were saving. Plus, again, we're getting all of these other benefits. We don't have any of the restrictions of a 529 plan. We don't have to worry about the volatility of the market, even though we could take advantage of that indexing strategy that I mentioned earlier. You can learn more about that in the description. So if we wanted to bump these numbers up potentially, again, it would depend on the performance of the market, but we would have that upside potential without the downside risk because we're not technically invested in the market like we would be in a 529 plan. It's a really, really important distinction. All right. But we safely put our money into a contract to give us all these benefits. And in 15 years, we have roughly about $173,000 in net cash value here that we could borrow against. So there's a couple different ways to access this cash value for your child's college education. All right. You could withdraw up to your basis. In this case, it'd be 150,000. We could withdraw tax-free. Now, if we withdraw any more than that, then now we're triggering a taxable event. We don't want to do that. And I'm not a big fan of withdrawing from these policies, especially if you want to then use it for retirement later on down the road, which you absolutely cannot do for a 529 plan. But we could take a policy loan against this cash value. So let's say the first year's tuition is, I don't know, $40,000. We could borrow 40,000 of this 173, right? But here's the thing. So we take the 40, it pays for the tuition or whatever it is that they need for college at that point. All right. There's no restrictions. There's no qualified educational expenses we have to worry about. They can use it for whatever they need with regards to their college education. Okay. Here's the kicker, guys. Here's what's just really, really powerful benefit that we get is our cash value is going to continue to grow, compound, uninterrupted every single year as if we never touched it. The reason is because when we utilize a policy loan, we are borrowing the life insurance company's money. Okay. And they're using our death benefit as collateral. This is a really, really important distinction and difference between utilizing a whole life insurance policy for college planning and 529 plan, because you can't do this stuff with a 529 plan. When you start taking withdrawals from the 529 plan, you're taking money out. That money is no longer earning interest for you. It's no longer participating in the market. With a policy loan and a life insurance contract, guys, that money, our net cash, our cash value is going to continue to grow uninterrupted, compound growth every single year as if we never touch it, because we're borrowing the life insurance company's money. And we are going to pay a little bit of interest for that. But that is a small price to pay to get these benefits, guys. It is really, really powerful. So our cash value is going to continue to grow even as we're utilizing it to pay those college expenses. And then we can put a plan in place to pay that policy loan off over time. And then guess what you can do, guys? Once that policy loan is paid off, let's say we do that at year 15. So in this particular example, I would be 50 years old. All right. So let's say we take out $40,000 per year for 4 years. That's $160,000. All right. There's going to be loan expenses. Let's say that takes me, I don't know, another 15 years to pay off. That's kind of stretching it. It shouldn't take that long, but let's just, worst case scenario right here. If I'm 50, we have this, by the time, let's see, we're 54, we have 160,000, but I'm paying I'm starting to pay that loan down, and I've got a plan in place to pay that down. By the time I'm 65, 70 years old and I have that policy loan paid off and I'm not making premium payments anymore, you see this zero right here? Again, I only set this up to pay into it for 20 years. But even after the 20 years, my policy is still going to continue to grow. The cash value is going to continue to grow every single year. So let's say at 65, 70, whatever, I've paid off the policy loans that I used to fund my kids' college education. So they've gone to college, it's paid for, my policy loans are paid back. My cash value has continued to grow uninterrupted every single year. By the time I'm 70, I have now 400, and this is just an illustration, but let's say around $468,000 in cash value that I now have access to that I can utilize for my retirement now. I could start to borrow, let's say 40,000. I could borrow 40,000, or again, I could make withdrawals as well up to my basis, but I'm not a fan of that. But I can now take policy loans for my retirement. Guys, do you see how awesome these policies are? I really hope so. I hope I'm explaining it in a way that's, the light bulbs are going on here and you see the potential and why these things are so powerful is at age 70, I have roughly around, in this particular example, around this much that I can now utilize for my retirement if I want to, guys. So I funded my kids' college education. Plus I've added an income stream tax-free in my retirement too. I mean, I'm pretty sure 529 plans cannot do that, guys. So I'll wrap up with that. I don't want to go on too much of a rant here. You can see how, I get fired up about these things. I'm really passionate about sharing these types of policies and this strategy with people because it's so powerful. We get so many benefits out of it. It's just incredible. So I absolutely love it. But anyways, like I said in the beginning, do your research. This is not necessarily to point you in one direction or the other, even though, I strongly recommend whole life insurance policies to people all the time, especially when they're set up and designed properly, which is, what we focus on. We get our dollars to perform multiple jobs here. So instead of putting it in a 529 plan where it can only be used for college, we don't have access to it either in the event of an emergency. It can only be used for college. It's at the mercy of the stock market performance. Hopefully it does good. Maybe it won't, maybe it will, who knows? Versus something like a whole life insurance policy where we don't have any of those restrictions. We don't have to worry about anything regarding the stock market if we don't want to. And we get this guaranteed growth. We have all this flexibility. Plus, we can use it for college and our retirement. I don't know. What am I missing, guys? I would love to hear your feedback. Drop some comments down below. Let me know what you think about this. If there's any specific questions that you have, I know this was a lot of information. And look, it's not something that, you learn in a couple of days. Like I studied this for months before I started creating content, and to where I was at a point where I felt comfortable sharing it with people. And, I was setting up my own policies and learning how they work and stuff like that. So, take your time. It's going to take a little time to do your research and understand how these things work, but it's so worth it, guys, because these things can be absolutely life-changing. And these are major financial decisions that we're talking about too. So we want to put the time in to do our research. So if a 529 plan makes sense for you, great. Talk to your advisor, get it set up. If you want to discuss your options for potentially setting up a policy, what it would look like for your specific situation, we can run illustrations for that, look at some numbers, and you can decide if it makes sense. If not, no harm, no foul, go another direction, but at least you have the options and you can make the best decision for you and your family. So I hope this was helpful, guys. Leave your feedback and any questions down below, and I look forward to speaking to you in the next one. All right, to your success. Matty Ice is out.